Last year, this thread kind of blew up for a company that I had seen in my peripheral vision but didn't know much about them, called Meow. And their founder and CEO, Brandon Arvanaghi, had just posted a victory lap of a tweet about reaching profitability and what a meaningful milestone that was. I was so impressed with that as a milestone that they'd set out to achieve and then achieved it, but also really blown away at the response that I was seeing online to this as a milestone. So rarely do people publish when they've achieved profitability. They tend to really make noise when they've raised a big round of funding. Here he was really espousing the virtues of profitability and what that meant for their business, this kind of idea of infinite runway and ability to focus on their customers, their needs, versus kind of what the financial markets or investors were looking for. This was the first time we actually had a chance to sit down, to meet, and to hear more of the backstory on Meow, which actually started in crypto and is now starting to apply a Costco-like mindset to financial services. And I think what you'll hear in this conversation is some really unique takes on creating value for customers and creating defensibility against your competitors. How do they deliver the most value for the lowest margins so that they can be the fiercest competitor? There are other ways to think about it. These aren't better, they're not worse, they're just other ways to think about building. And I think we tackle some of the kind of boogeymen of profitability, and we hope it gives you a whole new perspective. Enjoy this conversation we had with Brandon Arvanaghi.
Is there a tell for someone that understands the game at its core? Did you understand the game at its core?
Somewhat.
Okay.
Not entirely. I went into it a little bit naive. What I did understand was when we were raising at even an 80 million valuation. We raised at multiple valuations before our Series A. So we were at 15 million posts. I think it was 40 posts and then 80 million posts. And that was really pre-launch, or right around launch, 2021. So I told my co-founder, if we launch right now and pursue revenue and try to build a real business here, there's no more being Bainesian. There's no more Meow could be this. Meow's pre-launch, it's super exciting, right? The pure play thing from Silicon Valley.
Absolutely, the pure play.
Yeah. It's real.
It's real.
It's really
It's totally real. I mean, I remember, I think it was Josh Kaufman who said years and years ago, like, nothing ruins a good story like numbers.
Exactly, yeah. So that's what I understood very clearly. I was like, let's just have this honest conversation, Bryce, my co-founder, Bryce.
This is going to get really confusing.
Yeah, it will be. Yeah. And he said, look, I feel in my bones that fundamentals are going to matter again. This is in 2021. Saying that is
wild.
Kind of wild at the time.
Yeah.
And he also said, look, and I also want to build a real freaking business. And I said, I totally agree. That's what we understood. It's that we wanted to build a real business for sure.
So in those intervening years, those kind of successive rounds you did before, did you feel like you weren't being authentic to yourselves?
I wouldn't say that. I would say we needed the money and we needed to get more people kind of behind us. And these were on safes, so there weren't that many privileges that were granted. So with every round, we were able to hire more talented people, and we were able to get more backers on the cap table, like Packy McCormick or Saul Bloom or Austin Reef, like people with audiences who helped bootstrap the business.
Yeah.
Directionally, we're a fintech, so it's not like we're a SaaS company that we could just bootstrap, right? We knew we needed some concept of a balance sheet. The question was how little could we get away with to achieve perfect optionality for the future? And that was answered in our Series A. Our Series A was like, we feel like now we're in a pick your own destiny kind of situation. The goal was profitability. The goal was to get off the treadmill. And just having like long runway to figure things out was very important.
How were you feeling the effects of the treadmill pre-Series A, if at all? Examples of things they wanted you to do that you didn't?
All sorts of shenanigans. I'll give you an example. Like there were side letters they wanted us to sign without having like a meaningful investment. Like things like pro rata across like multiple rounds. We got away with not signing any of them, but like one, which was just like one round. And that person's been great for us. The Series A, there were all sorts of antics because that was when the market was tanking. We signed it, I think, at the end of April 2022. And then the diligence period, the next like 30 days was when, that's when the stock market tanked. That's when like Russia invades Ukraine. So we saw all sorts of antics then. In 2021 was like everyone getting rich all the time. So it was up only, everyone was happy. Some minor kind of games that we could just brush aside. But then like when the market gets to reality mode, that's when VCs kind of show their true colors a little bit. And that was like leading up to the Series A.
Were you surprised by the true colors when you saw them?
Yeah. If they didn't like kind of reveal who they were, like some of the people who wanted to invest like in that 2021 up only environment, then you started to see like the real nature come out for some of these people. I'll give you an example. Going into the Series A, it seemed like we would be a very hot deal. We would get a bunch of term sheets. like instantly. So there was a VC who said, look, we love what you guys are doing. We want to follow on like $4 million no matter what. I said, okay, great. And that was like very early. They couldn't have led if they wanted to. Then it seems like we're not going to get a term sheet at all. So we're no longer a hot deal. The conversations aren't going great. And then we go back to that one like strongly committed VC. And they say, yeah, your guys' style, it gives me pause. So I'm going to have to reevaluate this.
You're a sharp dresser. What about your style would give them pause?
No, I mean, just like the no nonsense with which we deal with VCs.
Yeah.
If a VC wants in on a deal, they'll say everything right. And if there's a macro factor or there's a reason they want to pull out unrelated to you, they'll just pick the thing that they like least about the deal, and they'll say that's the reason. But they have all sorts of reasons for themselves to pull out.
What do you think they meant when they said they were hesitant about your style?
They just meant you don't have a reputable VC leading the round anymore. I thought you were going to get that for sure. We wanted first dibs at it. So yeah, this isn't as hot a deal as I thought. So let me kind of walk this back a little bit.
Right.
And I said, okay, fine. And then we start getting term sheets again from reputable people. And then they call back and say, yeah, we'd like to participate the $4 million. Like we're totally in on this. Like, so I mean, that kind of just transactionality, I don't like it. We just hate being gaslit so much, my co-founder and myself. So
Gaslit is such a great word.
yeah, you have to be careful with VCs.
Were you always this skeptical?
Starting a company, you really just deal with all sorts of sharks. Like I've understood the game more as time has passed. Right around then, I think the Series A is when we saw all sides of VCs. Like it's such a roller coaster. Being hot to not hot to hot again, you see every side of these people and what they're willing to do to you. And they don't care about your company. They don't care about you. They care about looking good to their LPs.
Did that factor into your calculus at all? Like when did the relationship between VCs and their LPs snap into focus for you?
Seeing what happened during the Series A made us more cynical towards the concept of ever putting the ball in these folks' hand again. You want the ball in your court no matter what. We knew that from the beginning, but this was like, that's for sure, like after what we just saw there. The Series A was kind of a pick your own adventure for us. It was like get profitable as a primary goal. Series B was possible. And then just seeing all that, it's like, man, what good would it do to basically have people like this who treat you like this control you and determine whether you're going to be able to build a successful business? You want to just get away from that, like full speed. So we had 1 foot on the treadmill in terms of like raising from VCs generally, and 1 foot off, which was opting out of having to raise again. And we just decided, yeah, we're getting off this thing as soon as we hit profitability.
So when you closed Series A, how distant did profitability feel to you?
Well, 3 weeks after the Series A, we basically started the company from scratch.
That's what, from all the headlines, that's exactly what it looked like.
Yeah, after that it seemed very far. So we were a crypto company initially. It was a way for accredited investors to earn yield on their idle
That's
cash.
what it looked like. It looked like a yield farming thing.
Yes.
Okay.
So it was accredited investors specifically. It wasn't retail. That's very important.
Yep.
And for businesses, I think that was like 5 million plus in assets at least. And they could basically choose like a yield source on our dashboard. Many of them were like crypto lending desks. So we raised on that. That was the business, like going into the Series A. We raised on that.
Everybody's fired up on that business.
Well, yeah, it was still kind of a roller coaster because of the macro, Russia invading Ukraine, stock market tanking, et cetera. But that was the business. That was very much a business. Then Series A closes. A couple weeks after it closes, we start hearing rumors about Three Arrows Capital. They're a crypto hedge fund.
That's right.
And that's the kind of thing at the time, to put yourself in the shoes of 2022, that was wild to hear rumors about that. In like the TradFi markets, that would have been like a major bank.
And the rumors started with what?
They're not paying their debts or something like that.
Okay.
So upon hearing those rumors, we were just like, okay, we're done with this. We should not be hearing these rumors. So what we did was we got all the money out of all those kind of sources. We just sent them back to customers. Revenue basically went to zero overnight. And this is 3 weeks after raising a approximately 22 million Series A at a 127 million post-money valuation. So we did that.
This is literally what they call the oh shit board meeting.
Yeah. We didn't tell investors beforehand we were going to do that.
Okay, so this is the question. When did you start communicating that what they invested in was out and what was going to be the business going forward?
Yeah, so immediately, we didn't hide anything either, but the first thing to do was to get the money out for our customers.
Yeah.
Easy. I was not going to wait for a VC to opine on the matter, right? Give their 2 cents on the matter. So we held the money immediately, had it in our balance sheet, and I called all the VCs. And that was kind of the moment of truth to see if the people we chose were the right people for building a long-term business. And thank God, to their credit, they were all so supportive. I mean, we picked the right people. And we got very lucky in that because we didn't know for sure, but you just know there's a vibe. There's like a general sense going into the meetings that these guys are no nonsense. These guys get it. They want to build a long-term company with us, not a short-term thing. We spoke to all the investors and they were all super supportive of it, which was awesome. And yeah, it had already happened at that point, to be fair. but they were super supportive.
Asking forgiveness, not permission.
Yeah, I mean, I would never ask for permission for something like that. For
sure.
But I talked to my team with my co-founder and I said, guys, we just basically started from zero, but we're gonna figure something out. And the only thing I care about is customer trust at the end of the day. That's the only asset that has to increase. I don't care about assets in the platform. Waves will go in, waves will go out. Customer trust only goes up. Doing right by customers only goes up.
This is very non-consensus for being in crypto at that moment.
Yeah, crypto was always a wedge for us. It was always like, we wanted to build a B2B suite, and that was like the wedge to get people on the platform.
Fascinating, yeah.
So then what we saw was that we started from zero. Interest rates were rising now, again, with like, inflation kicking in, the war. We basically built a dashboard for businesses to buy T-bills. And a lot of the same customers who we had returned all the money to were very excited that we had a new product out because they liked us. And they became our first customers to buy T-bills through our dashboard.
Is this pre or post SVB?
This is pre-SVB.
Got it. Okay, interesting.
Yeah. So the T-bill dashboard did well. And we do make very little on that still. It's 1 BIP a month. And we don't charge any spreads or anything like that. But that did very well, and that was like idle cash. And the growth was crazy. It was like 100 million the first month. The next big kick in the pants is like SVB happens. That was just nuts. But that was a story anyway of starting from zero and telling VCs afterwards.
So then how do you crawl yourself to profitability from there, literally starting at zero?
Yeah.
I think that's so intimidating to founders. So many of them have never even seen it happen, right? Like if you've been in the startup world, I think the idea of profitability either feels unattainable or feels almost certainly like unaspirational.
I agree with that. Unaspirational is a great word. Why do you think it is?
I think one, no one's seen it, and so all they've heard are stories of companies that incinerate cash for years and years and years, and then something. What's that meme where it's like ... profit?
Yeah.
I think the way that we've told founding stories for a long time is ... profit, and I think we skip over the parts of the stories. In the case of Facebook, everybody anchors on how much money they burned to get, to like build out this moat. We've posted videos of Zuckerberg talking about how early they got to profitability in that business. Yeah. Like Google, another one where, like a lot of these companies that I think we're taking a lot of the wrong lessons from them, and I think they're in many respects like self-soothing stories where someone who's built something that people actually don't want or need can tell themselves. There's the flip side of it, and you've touched on a little bit, is I think that the incentives around fundraising are just so strong. And for a lot of companies, it's easier to, they see funding as an easier and more aspirational path for validation of the business than they do, achieving profitability.
Oh, for sure.
And then it feels like, this is what I'd be curious to hear how you process it, which is I think a lot of people hear profitability and they suddenly, like a switch flips in their minds where they think it means slow growth, they think it means lifestyle business, they think it means less ambitious founder. I don't know why that is, but it feels like there's a real tension there. And I don't know if you heard that from your peer set or you even felt that yourselves when you set that as the target.
I have heard it from a peer that their growth is entirely dependent on spending copious amounts of money.
Yeah.
Which I think is going to set you up for failure regardless of whether you want to be profitable or not. So the sooner you deal with that problem, the better, because I think the ability to just spend $10 to get $1 back is it's not serving anyone well. So have the tough conversation now, like take the medicine now.
How does that founder rationalize it? When you two unpack that strategy, I would imagine you're sitting there going, like, you're an idiot. Yeah, like you could see how we could see how the story ends. When they try to process it, how do they process it to justify it?
He asked me like, how are you doing this, et cetera. And I said, well, like, we're able to continue to triple or double every single year into infinity. This is financial services. We want to stay lean as well for a lot of reasons. And then he just said, like, yeah, it wouldn't be in the cards for us. Like, so much of our growth is dependent on like spending a ton of money. And that was the end of the conversation. So
it's so fascinating.
Yeah, I don't really know what the plan is there.
Right.
I wish him luck.
How did that go internally? Like, what changed for you as a founder and for Meow as a business when you actually did tip into profitability?
So I talked about how it was kind of a pick your own adventure, and then the closer we got to profitability, the clearer it became that there's zero benefit to us like having to do a Series B or putting ourselves on the treadmill and building the same exact kind of company as all the incumbents, all the competitors with 1,000 people. There's just so much we can do that they cannot do, in my opinion.
What are some examples?
If you have 1,000 people and you have crazy ass valuations to justify, in my opinion, your pricing goes in one direction. That's just worse and sneakier. So your cash back becomes points. Your checking account from your partner bank doesn't pay interest. Your fees on invoicing go up. I think the sneakiest one is the conversion of cash back to points on a card and then quietly diluting those points when no one sees it. Whereas, if you don't answer to a board and you never gave into the dopamine hit of hiring 1,000 people, you can go in the opposite direction. You can push the limits of the economics you give back, because all you have to do is be profitable, right? And that compounds over time. I mean, the more people that know about that, the delta between you and everyone else who has to answer to these crazy VCs who need to show something cool to their LPs, and like, it's night and day. So that's a huge advantage we think we have. And I don't think anyone actually understands that. It's like a very small subset of people understand that how we've structured the business to not answer to anyone but the customer is a enormous moat that only gets bigger come like 5-6 years.
No, it's an interesting calibration for a business when you can focus on a milestone that doesn't move versus, to your point, when the milestones revolve around a certain percentage of growth that you need to show to raise your next round.
Yep.
Those goalposts can move. I mean, you saw it with your Series A. Those goalposts can move overnight.
Exactly. Yeah. What, in my opinion, happens is that these giant companies that are valued at 10 billion plus, they have trouble hitting their growth numbers from net new customers, right? So how do they show growth? They look to their existing customer base to show that growth. And what that means is quietly jacking up prices on them. So it's like you have this unattainable valuation, this unattainable growth target for net new customers. When you don't hit that, you got to look to the people who brought you here and do wrong by them, in my opinion. And that's a tale as old as time. It's a tautology, in my opinion. It doesn't. It's true. So if you don't have that kind of crazy milestone, crazy unattainable this, then you can compound forever profitably and sustainably, and you don't get disrupted as well. That's the other benefit.
It seems like the knock-on effects of profitability for you are very, very real, both in terms of product decisions and company decisions. How does it manifest itself in the product? Give an example of a decision you've made that you wouldn't have been able to make if you would have been on the treadmill.
Hiring comes from a deep distrust of revenue, which I think every founder should have, especially seed ones. If things are looking gravy, and you're making a ton of money, then it's like, let's raise another round, let's hire a ton of people. I think revenue is very fleeting. I think it can go away in an instant. It went away for us, right? So,
yeah, we've said over and over, like revenue is every bit the vanity metric that eyeballs or anything else is, yeah.
Exactly. So just a deep distrust of revenue is important, because I think if you stay in the game, you win the game. Now, there's not a concept really of staying in the game if you are having to justify a deca-billion valuation with 1,000 plus people. It's like, get to the next fundraise, get to the next fundraise. You can't think on 5, 6, 7, 8 year timelines, in my opinion, when you're thinking quarter to quarter. That's the key advantage that we have, is that we're thinking on longer term timelines. And that's the entire thesis of the company, is that this Costco model of financial services that we're trying to do is something that doesn't show crazy profitability numbers in year one, but it creates a moat, a business equation that nobody can disrupt in 6 years. That's something I can only do if I'm profitable and I don't have to answer to anyone else.
What's your hot dog and soda for $1.50?
Yeah, it's a good question. My hope is, I can't say this definitively, my hope is we never have to charge SaaS for any product. We hate SaaS.
Oh, fascinating.
Yeah.
Okay, why do you hate SaaS?
I just hate being gaslit. So the concept of paying per seat for something where the marginal cost of distributing it is zero in software kind of rubs me the wrong way. Now, I know there's a marginal cost associated with onboarding a new customer to a product, adding someone, but you're paying for bytes and a little bit of support cost. It's not, there's too much margin there. For like, if you have 30 employees, you got to pay like $20 a seat per month. Way too much margin. So if I can get away with no SaaS ever for business banking, fintech, and credit cards and stuff like that, I mean,
do your customers feel the same way?
Oh, they hate fees, yeah.
Okay.
They hate fees. People hate fees more than anything. That word fee, really, yeah. We attract the shrewd customer. I mean, the ones who actually care about the economics. They know when they're being gaslit, and that's fine. That grows more and more over time. And then and then the plan is to basically become the default for the people who don't know any better that they might be getting raked over the coals somewhere else.
How much of yours is coming from these competitors where someone's wised up versus net new?
A lot come from them,
Oh,
but I'd say like fintech is only 5% of the market, right? So there's a lot of people still on regional banks, on big banks, et cetera, that we convert. We don't need any of the incumbents to fail. I just think we're naturally going to outslope them violently. But yeah, a lot of them, once we tell them like, hey, checking accounts from partner banks can pay interest. Does yours? What kind of cash back are you getting? Is it points? Is it cash back? Are you getting charged SaaS on all this? Like, they understand.
When did the Costco metaphor take hold for you?
Early. My co-founder came up with it.
Is that right?
Yeah.
Okay.
He's great. I mean, he's like ChatGPT for the right answer. We're very lucky to have Bryce. His name is Bryce.
Something about these prices.
Yeah, seriously. Yeah. It's just a great model. I mean, we haven't seen someone try to apply the Costco model to financial services. So the CEO famously says, Costco is a volume business, not a margin business. I have not seen a fintech, a business banking fintech, consumer fintech, do that model of pass back the majority of the savings to the customer, beat down vendors on price, and give the best possible deal they can try to do to the customer. And that's an enormous vision to all of financial services. So that's the power of fintech. The power of fintech is you're not tightly coupled to one financial institution. You can pit multiple against each other like Costco does with its vendors, right? And when you do that, you get the best possible pricing, in my opinion, for the customer.
Now, one thing Costco did is they created in-house products. Is that something you think about too? Like, is there a Kirkland brand of Meow?
We want it to be such that anytime we add a new product, people know it's Meow quality, and that means price number one.
Okay.
Over time, the Costco model is only achievable the closer and closer we get to bare metal.
Yeah, I bet so.
We know that that's going to happen over time, closer and closer. But there are steps to get there, iterations, and we can still do a very good job like on the way there.
So how do you compete with those incredibly well-funded competitors who, I can walk down the street here, I'll see billboards for any number of your competitors here, I'll see buses wrapped in other cities, how do you compete with that?
I think of it like a war a little bit. Like, we don't need to like defeat them head on, but it's good to understand the market. So if they have the biggest Navy, the biggest sales team, the highest valuation, how do you win that, right? How do you break through the noise of that?
I think honestly that justifies a lot of fundraising in a lot of people's minds, right? That I just need a bigger war chest to be able to compete.
Yeah, but you're never going to have a war chest as big as them. At best, you're going to be this awkward kind of pimple face, like in between thing. I also think the best way to defeat that is to be on the polar opposite end, which is the leanest, the one that pushes the max economics possible to the customers. That's how you win, is by going word of mouth, not playing the same game. And if you can just have a big enough delta on economics, you stay lean, you think on 5-6 year timelines, whereas they're thinking quarter to quarter, I think it's hard to lose that, honestly. So yeah, it's asymmetry. I'm a big believer in asymmetry as a strategy.
Why do you think more founders don't follow that playbook?
I think there's a lot of status games associated with raising, and I think you find yourself with scar tissue that you didn't expect or you didn't know any better about. You just knew you were getting praised for raising and getting the reputable term sheet from the institutional VC or something, right?
It's funny you say that, because I always get in trouble for calling venture capital daddy issues with a business model.
That's good. That's really good. Yeah.
But it's amazing how much we've allowed it to become that. It's in so many respects, it can be approached as like a status game, a credentialing game. And I think maybe part of the knock-on effects of that is you get people building fundable businesses, not necessarily businesses they actually care that much about, or for customers they actually care that much about. But they knew how to kind of craft a narrative and a story that could get investors off the fence.
Yeah, if you raise money like during the NFT boom, and you liked NFTs that year, then suddenly you're in a decade-long marriage with VCs who have board seats and like pref stacks on you for an NFT business. Like, are you ready to run the distance for that for 10 years? Like, what I always say is there's a Venn diagram of the VC's interests, the founders, and like what's good for the customer. And there's an intersection, but it's small. Most of it is outside the intersection of it.
Right.
So VCs want the markups, they want to look good to their LPs, they want to raise their next fund to clip 2% more management fees on that. The customer doesn't care about any of that. The customer cares about a good service at a low cost. Can those overlap?
Do you think the customer is getting more informed about the knock-on effects of who's funding their companies? Because I know in the past, a lot of founders justified it by saying like, oh, my customers need to see or my partners need to see that I have this really healthy balance sheet, and if I have XYZ fund on there, it's even better for me in those situations. Do you think that continues to be a net positive for the company? Or do you think there's a universe of partners and customers who are waking up to the relationship between those investors and like the ultimate product they end up paying for?
That's a great point, and that's probably the most pro VC point you can make, is that partners and vendors will diligence you differently depending on who your VCs are in your cap table. Now, you can overcome that by bootstrapping and just getting more customers. That's the harder way to do it. But if you have a reputable VC on your cap table, they do a lot of the selling to you for the vendor to give you better pricing. Or for someone.
Have you seen this or felt this? You have. Okay, how did it show up?
Without saying names, and I'll tell you about the downsides of this too. Some of our seed investors were multi-stage investors, so they could have led a Series A or a B, and they were very reputable names. So that was very helpful for us in our outbound campaigns, our Twitter, our LinkedIn. But come Series A, the question I got from a no-nonsense VC who I admire, they're not on the cap table, was, if you're so good, why did these people let you go to market? Why did these multi-stage VCs let you go to market? So there's all sorts of costs, even if they're just like a small check, even if they're just like a $100K check at a small valuation, just like a let's get to know you check. You run into those costs even if they don't have a board seat. And then there's some 24-year-old associate at this place making the decision of whether your company's going to be able to get a round done in the future or a successful period. So it's a trade-off. And
so some people have tried to dismiss, some would call this signal risk,
yes.
Right?
Yeah.
And so some people, the big firms would like you to believe that signal risk doesn't exist, that if you're a great company, you'll get funded in any environment. You've certainly proven that point, right?
Yeah, but that was existential in my opinion. That was close to not happening. That was a big headwind during the Series A.
Oh, okay.
So you have to be careful. Look, I'm a big believer of stay in the game, win the game. I'm a big believer of if you have the ball on your court, you can't lose. If I were to do things from scratch, like fundraising, I would get funding from angels that I know, and maybe a one round, like a pre-seed only fund, or like an indie, right?
So you heard it here first.
You have no scar tissue. You have no existential threat that poses. You don't give up any control.
What I've found is that you have a partner who's actually aligned with that approach. I think, we talked a little bit earlier about how long we've been talking about this approach to building businesses, and I think it's pretty in vogue right now for people to at least suggest that this is something that they're supportive of, or even would like to see more of. But the reality is that it's a harder path, as a fund too, to have a company that goes years without a markup. LPs can look and see that this is a profitable, growing business, but they don't know how to value that. And I remember one of our LPs in prior funds said something along the lines of like, you're playing a value hand in a growth game. And so I do think it takes a certain kind of investor to be aligned with that. And I think it's so much harder to actually align with it than to give lip service to it. Because even I've found in companies where we've backed them and brought in co-investors as part of those rounds, we just have wildly divergent approaches to how to work with founders. And you really start to see crystal clear the the kind of incentives that are on the table for folks.
In my opinion, what LPs do understand is what zero is.
Yes.
And a lot of these companies that had the markups, et cetera, they go to zero. They go straight to zero. And it's because of their growth, not despite it. So I would rather be of the camp of having a tougher time identifying the true value of the company, but knowing it's growing and it's winning and profitable. Right. I totally empathize with the point.
Well, no, I mean, it's to your point. We did one of these with Eric Paley from Founder Collective, and his point was like, compounding works both ways, guys.
Yeah, exactly. Exactly right. Yeah.
It really, you can go to zero just as fast.
Exactly.
I know for me, when we talk about indie to LPs, one of the very first questions they ask is liquidity. In their minds, they think, well, these entrepreneurs will never sell. How do you think about that question? How do you think about like liquidity, exit, all that stuff?
Yeah, I think being profitable,
if at all.
Yeah, it's a superset of the possible outcomes than on the IPO or bust train. If you're profitable, you can IPO. If you're profitable, you can do dividends. If you're profitable, you can get tender offers very easily. Being in a position where you don't have to raise gives you the entire universe of outcomes, which provides liquidity. So now when investors come to us, which is at an all-time high, by the way, even though we said we're not raising, we tell them.
This is literally, I mean, when did I write that post?
Yeah.
I wrote that post in probably like 2016. I said, this is like the ultimate pitch deck.
Yeah.
And it was one slide that said, we're not raising.
Exactly. Exactly right. These are lemmings, right? These are lemmings.
It's amazing.
We tell them, like, we're not raising from you, but if you want to get on the cap table, you can talk to our existing investors. There's just so many more ways you can get liquidity for your cap table, your employees, if you have a sustainable business model, in my opinion, than just IPO or bust. And you can have a better outcome, better returns, in my opinion, than that.
So why don't you think we see more of it? I mean, I do think...
You know how intoxicating it is to do the treadmill? Like, get the press waves and have everyone think you're cool and stuff? Like, it's a lot of dopamine involvement. I think it's that simple. Because every power structure in the VC ecosystem is designed to reward you for that, because that's how the VCs get fed, right? They get the new fund from the LPs. So VCs will encourage and promote and king and queen make the founders who do the treadmill as well, because the VCs get fatter from that. You need founders who, first of all, don't care about the VCs praising you or the dopamine hits. And you need VCs who understand that playing a game that pays off in 6, 7, 8 years will beat everyone else. And that's new. It hasn't really taken off yet. It's starting to. It's very exciting. And I think, yeah, we're very grateful to be on this path. I think it's going to change the game. In 2021, I mean, we blended in with just about everyone. I mean, there were companies there were a ton of people doing what we were doing. And like business banking, fintechs too. And we saw the founders, like they were not taking it seriously. Like some people were tweeting like, if you know, you know, just like hype things. We instituted a no hype rule. We can only do pre-announcements 24 hours before the actual product is live. Not a week, not like, I can't wait to show the world what's in store this year.
Yeah.
Anyway, all that aside, everything kind of seemed the same back then, right? Most of those companies are not in the game anymore. I think that's kind of the proof in itself. And if people just compound, I mean, that has venture-backed returns. That's the important thing. You know, tripling, doubling forever. You can return the entire fund in a less risky way, in my opinion, than the unsustainable kind of ladder.
That's the math that people haven't done, but is actually incredibly compelling when you get into it, right?
Yeah.
We have companies in our portfolio that haven't raised for 6 years.
Yeah.
They're growing profitably. They were small single-digit millions. When we funded them the last time, they're now in 8, 9 figures of revenue, and none of us have had to dilute in there.
Yep.
None of us have.
Exactly right. Yeah.
And the other thing is we haven't had to be distracted going out to market to always be raising or whatever kind of thing people are trying to get founders to do. Right? They've just been able to focus on the customer.
Yeah, the math works.
The math works.
Yeah.
That's just it. Even if we sold at a smaller multiple, it's still a massive multi-fund returner.
Exactly right. I don't know why no one's done the math like publicly.
Well, I think to your point, you had something that I thought really resonated with me, which was the PSYOP comment. And if you look at the timing for funds and fundraising for the underlying funds, makes perfect sense. I mean, I don't know, if you want to rehash what you'd said about, the 18-month window of fundraising, because everybody raises and says, I want to raise 18 months to 2 years of fundraising.
Yeah.
And you call that a PSYOP.
It's a PSYOP. It is absolutely.
When did that click for you, though?
That specific insight was this year. I knew.
I was going to say, because that felt new and it felt fresh.
Yeah.
I liked it.
That's fresh. VCs will tell you, burn enough money that you're at 18 months of runway, right? They just came up with this magical number, 18 months, right? And you think about that, you unpack that. It's like, why are they telling you to get to 18 months of runway, regardless of what your business is, regardless of what vertical you're in, regardless of what long-term goals you have. Say you have a plan that's going to pay off in 4 years, right? And they still tell you, get to 18 months of runway. Why would you do that? And the reason they want you to do that, it's a PSYOP, is because that's how you come back to them and give them the optionality, the perfect optionality to get first dibs and be able to save your company so you have no leverage and give you a markup for themselves. So they decide, they have perfect optionality to give you a markup, higher valuation for them, that makes them look good to their LPs. That's their goal. They don't care about what's best for the business. It's just keep coming back to me every 18 months so I can continue to look good to my LPs and give them the update, and then I can go raise a new fund from those LPs. All about getting the new funds. Once you understand that, VC makes sense. Once you understand that VC is a game of selling and storytelling to the LPs, everything makes sense.
Are you just a jaded founder?
No, I understand the game now. It's nasty. I mean, there's just so much.
Isn't it wild though? But it's wrapped in like the most warm and fuzzy of all financial product marketing.
How so?
I think it's actually the perfect financial product because we're not in it for the money. You know what I'm saying? Like I'm saying, like
exactly, yeah.
This isn't about the money. This is about the future.
Yeah.
This is about the dent you can make in the universe.
Yeah.
We only want to work with the best, most ambitious, category-defining people. And if you fund me, does that mean I'm a category-defining founder?
Right.
Aside from the money, like think about what that does to someone's ego, to their relationships around them, where they can go to their parents and say, I know you thought I was unemployed last week, but this guy who was on a podcast, these people who look at all these companies they've been involved with, they believe in me.
Yeah.
And suddenly you're incredibly credible. And then I think the flip side of that is too, I mean, there were some numbers that are coming out right now around like number of companies valued over 500 million, which is into the hundreds, maybe thousands, and number of exits over 500 million.
Right.
And those are in the like low double digits.
Right.
And so the other thing that the funding landscape has become is its own business model, right?
Yes.
If you're an ambitious founder, you don't have to wait anymore for 10, 15 years for your liquidity.
That's true.
If you can create enough heat around your next round of financing, there's going to be a little, hey, we'd like to put in a little bit more than you're trying to raise right now.
That's true.
Or as a founder, you can go back to the 3 people who want to give you a term sheet and say, look, we love all of you equally, but what would really sway us is, 5 million here, 10 million there. In secondary, and suddenly you've got a real business model, you've got real liquidity, and so everyone in the LP world and in the press world is saying like, how is this happening? How is there no liquidity? It's like, dude, there's been liquidity. It's just not your liquidity. You're the liquidity provider in this case, right?
That's a great point. There's an incentive problem. So these giant institutional VCs that raise tens of billions of dollars in their fund, right, 5 billion, they have to credibly deploy that fund. And so they need the founders that are the most outlandish, like the most press-oriented, the most quirky, like remember Sam Bankman-Fried was like playing League of Legends while he was on the fundraising, right? So if I went out there and I stopped wearing shoes and I would just get on like League of Legends games while I'm pitching people, that's a story that they can tell to their LPs, the VCs, right? Like, oh, this person's on another level. They're going to revolutionize everything, AI, crypto, fintech, right? So that's a service. The VCs need to find these people who have these incredibly like unsustainable models, in my opinion, so that they can deploy it, so that they can tell the story to the LPs, so that they can get their next fund. And the founder is very much the product there. So the founders get compensated in secondaries from that. Now, I'm pro-secondary, just to be clear. I think
likewise.
Yeah, but the examples that I'm talking about are like in the hundreds of millions, and that is because they're doing a service to the giant institutional VC funds.
Exactly right. And as you're saying that, my mind immediately goes to like narrative construction. And if you look at, crypto was so narrative driven, and I think, VC would like to suggest that it's something different. But, you create heat around narratives. You create heat by branding a type of investing or a thesis for investing that then takes off something a la like American dynamism or something like this, right? You can create your own momentum and heat around a lot of this stuff.
You talked about like how VCs brand themselves as like, you go to their website and they'll say, we're the contrarian ones. Like we want to just disrupt the status quo, invest in founders who are just against the grain. It's never true. They will not invest unless you have someone more reputable than them leading. It's the most follow-on behavior possible is to say
Was that surprising to you how, really? You thought you were walking into a bunch of independent first principles thinkers.
Yeah, and it's honestly probably like 1 out of every 20. It's the person who actually writes the first check despite everyone around them passing. That's the real, that's Charlie Songhurst for us. I will run through a wall for that man, for what he did. But keep in mind, before you're a founder, every single person probably looks at VCs as this mythical, you see Shark Tank, right? You're
totally.
Like, oh, VCs, they understand everything about every business. I would love to learn from them. And these people are awesome. They are lemmings. That's what you realize when you're a founder. They're followers. They want to deploy the money credibly by finding someone more reputable and just kind of tagging along and then telling their LPs. 1 out of every maybe 20 is the one who will actually go to bat, actually have a contrarian take, and actually hit the big returns because they're contrarian. There's a washout coming in the VC industry, and it's for the best for everyone, for founders in the future and for the VC ecosystem.
Okay, what's going to be the driver of the washout?
The liquidity is drying up, or at least it's going to consolidate. So all the first-time funds, I think, will not get re-upped from 2021. I'm reading articles about that. Like,
we see that. I mean, last year was like a watershed moment where 80% of LP dollars went to essentially 10 funds.
Yeah.
So that kind of vibrant ecosystem of first-time managers or potentially new contrarian perspectives is drying up overnight.
That's good for everyone, right? I honestly think back in the days of like 2004 when Mark Zuckerberg was starting Facebook, was it 2004, around then?
Yeah.
I think it was easier for them to build generational companies than it is now. Even though the tech is way easier now, even though there's like multiple fronts of disruption, the fact that there was less money flying around meant that every founder or founder archetype had to consolidate under one roof. The 50th person at Facebook was probably a generational founder in themselves.
Yeah.
And the problem is like VC is killing VC because everyone who would be an employee under like a very strong leader like a Bezos or a Musk or a Zuckerberg has their own startup that has $3 million in funding as well. So the talent density is much more difficult to come by.
Yeah, I mean, there's that meme of like people lining up down the street to fund the next OpenAI, expat.
Yeah.
And everyone knows that now.
Yep.
And so if you even have a bad day at one of these kind of hallmark companies,
Exactly.
you raise your flag. You've got, many of you have $5 to $10 million lining up.
Exactly. And it's just hard to like even put in perspective like what would happen if everyone just got under one roof. And I like to think that I would be the head of the roof, right? And that's the problem. But
everybody does.
But, and that's the problem, right? But if you actually take out the money from the ecosystem, then the cream actually rises. So I might be humbled, and I might actually find it's not me, and then I'd go under a different roof.
I think to your point, there was some data that came out a couple of weeks ago that was along the lines of we had tens of billions more that went into startups than ever before.
Yeah.
And we've ended up with fewer, not more, breakout or generational types of companies. So it's actually the money has never been the bottleneck. Mm-hmm. I look at those numbers and I say, how many of those companies would have been able to become generational companies if maybe they'd raised half of what they raised, a fraction of what they raised? What if we distributed those dollars to more and different types of founders and ideas? What would that end result be? I say that only because I have this thing that I talk about with my wife as it relates to our kids, where you want your kids to struggle. Mm-hmm. But you don't want them to really have to struggle. And so I call them synthetic struggles. Like how can you simulate, is there a similar way or a similar style to create synthetic struggles as founders for your companies to really create that more durable type of DNA in your business and in your employees than this kind of, when the money hose is flowing freely, you don't have to have discipline. You don't have to say no to things. So is there a way to create that for yourself? And it sounds like in your case, maybe the answer is profitability. Like you put that constraint on yourself. Nobody else did that. In fact, I would imagine your investors you would have had a spectrum of responses and reactions to that as the target.
Maybe in 2021, but now it's it's in vogue. I think even if you're a seed company and you're a founder of it, you can shield yourself from struggle. Like even if you raise $2 million, you could just hire head of ops, chief of staff, EA, customer support. You can just kind of enjoy life, take Instagram pictures, travel. I think it's up to you as a founder if you're going to face that struggle. And that answer is, are you going to build a real company or not? The founders who get punched in the face daily, who opt in for that, who want to take the abyss head on, the darkness, and grab it by its horns, they will rise. But you can't force struggle on someone who doesn't want struggle, that doesn't want to be a founder actually. They want the pictures. They don't want to be a founder.
They want to play founder.
They want to play founder, play house, exactly.
Yeah.
I love that line from The Departed. Have you seen The Departed?
I have, but I'm curious to hear what line.
Yeah, they say to Leonardo DiCaprio, do you want to be a cop or do you want to appear to be a cop? And appearing to be a cop is you have the badges, you go you get the prestige. being a cop is like going undercover and getting no glory for it. It's like, what are you doing Saturday night as a founder? Are you in a dark room replying to customers? Or are you partying, right? So there's a big difference between like dressing up and playing founder. Like there are conferences I could be speaking at like across the country that would look great, right? But they provide no value to my customers.
I want this to be on camera because we offered to come and record at Meow HQ, and Brandon's answer was like, "You do not want to record at Meow HQ. This is not a place for people with we're here to grind.
There'd be no room.
There's no room. Yeah. There's too many people. This is someone who's running an incredibly lean business."
Yep, that's true.
Which seems antithetical. Like people want, I mean, how many people post pictures of their office as like a trophy?
I have a thesis about hiring. When you're at a startup, you want to sell the person, but then you want to try, still in the interview process, you want to try to scare them away. Like get them to say, no, I don't want to join. Because the people you attract with the sexy office, they're easy come, easy go. As soon as you're off the treadmill, as soon as you haven't had a press wave of like sexiness or like a new fundraise or something, they're gone. Right? They're fair weather, they're tough as glass, they can't get punched in the face. You want the people who see the WeWork, where it's tight. There's very little natural light. There's 6 people, right next to you.
Right.
There's not enough room for phone calls. Some of our employees stay in a phone booth all day.
That's
I think
amazing.
It's against WeWork policy, but they literally just post up there all day. Those are the people who make a generational company.
Do you find that the people interested in joining Meow changed after the profitability announcement?
I've come to realize that it's tough. I remember being 24 and understanding that, or thinking that the fundraise is the success, right? The announcement of this and then showing all your friends. And there's no difference between a fundraise announcement and success of a company. Because then you have like this value of the equity and you can do the math on your equity and it's like, oh, if it 10x's, I get this. And look at Forbes and look at Bloomberg saying this. Post profitability, it's difficult to explain that all those places I worked at or that happened, I haven't seen a penny from them, right? It's like, we're doing things differently. So not only can our customers have the best economics, but you can actually get a payout. Like this should be the last job you ever work, hopefully. So it takes certain people, like a certain temperament. We do not have success going from sexy startup with a flashy fundraise to Meow. It's gotta be the person who wants to break in, and then by the time they're in, they get that this is the only way, they can't go back. So we've had two founders leave Meow to start their own companies. They've both, in my opinion, done it the Meow way of staying lean, focusing on profitability, and they're savages. Yeah, it's difficult to teach someone who has only seen the up and to the right fundraises what it means to build a generational company really in 2024.
You said the Meow way. What's the Meow culture?
Intensity, customer first, ownership, no nonsense, lean, wear different hats. No level of indirection between the executives and the customer. The customer, if they have a support issue, I should be woken up about it personally. And that's how they run their businesses too.
Given the outreach after the post, is there a playbook that you could distill down for anybody who's saying, I'm on the treadmill, I want to get off, hemorrhaging cash, I want to stop the bleeding and get to profitability? What advice do you have for them?
It's a very hard problem. It's a very, very hard problem because if you're at Series B and C and you feel like that, you have to have a tough conversation with your investors. Now, the silver lining or the light at the end of the tunnel is that everyone wants the same thing, which is for you to continue the business. Your customers want that, your investors want that, and you deep down want that. This is what you've built, right? Starting from scratch is the abyss all over again. Understanding that, if your investors actually understand the difference between you staying and leaving to start something new is getting this right, like restructuring the cap table basically, they will come to the table or else they'll see everything go to zero, right? So just be very direct with your investors and say, look, this isn't sustainable. I'm not gonna keep doing this. If you don't play ball with me, you're gonna have to find someone else and they're not gonna do as good a job as me. So tell them that.
That's gutsy.
Yeah. I mean, what's the alternative? Being miserable and like having the company go to zero over time? It's always better to take the medicine up front, in my opinion.
What do you think about the people who just give the money back?
Yeah, you can do that too. But again, I don't think that's what anyone wants, right? If you so.
They'd rather have you pivot for the next 10 years.
Yeah, I'm all for, I actually think it's the best thing is grind it out and find something, but just don't be in a position where you're grinding for a cap table that's unsustainable for you, that has no chance of victory for anyone. So you can give the money back, which investors don't want, in most cases I think, or you can figure out a different structure that makes everyone happy.
Have you seen that work? Where people like restructure their cap table?
This is a new phenomenon in my opinion, like
Yeah.
thinking this way, so I haven't had the case studies for it.
Yeah.
But at least in theory it works, right?
I think in theory it can work. I haven't seen it many times where a founder proactively comes back and says, I'm done, or I want to keep building, but in order to keep building, we've got to reset. What I see more often is like, I'm grinding, this isn't working. I actually don't have another pivot in me. Like I can't find the venture scale thing in here you guys need from me, so I'd rather just give you your money back and I'll go do something else.
That's the default.
I think that's the default.
Yeah.
I think that's a default for some. I think the bigger default though, and I think it's something that I've tried to communicate to people as well, because I think there's a category of founder who grinds it out because they think they owe it to their investors to grind it out. I took these people's money and I can't lose it. Or I took these people's money and I've got to get them a return on this. And you know, I think where I shake out on that archetype is move on. Like the reality is your investors wrote you off.
Yeah.
If it's really not working, if there's no business to try to save, your investors wrote you off a long time ago. Yeah, I've watched this multiple times through my career. People grind it out for like a decade on something that's not working out of loyalty, only to essentially get acqui-hired at the end, thinking they were doing their investors a favor, and the investors haven't returned their call for years.
And that's because those founders are good people at heart.
Yeah, I think that's right.
Yeah.
Yeah, but I think they also, like, again, understanding the games you're playing, when you know that they're carrying it at zero and you don't care about it like you used to, you got one life, man. Go move on to the next thing. Go take a job at big tech, you know?
I understand what you're saying. You're exactly right. It's tough because founders are the way to get success is also to get punched in the face and never giving up. So it's like, how do you determine, right?
How do you determine?
I think that the one thing I would recommend on that front is to not pick something with market risk. You know?
Say more about that.
Yeah, I mean, I see so many Silicon Valley founders, like seed companies, 22-year-olds, et cetera. They just pick something that's never been done before, that there's no proof that it exists as a market, right? You want to pick, in my opinion, like even Elon Musk, the greatest entrepreneur of all time, none of his companies are things that did not exist in some way, shape, or form. He's doing an order of magnitude better on every single one of them, right? SpaceX, Neuralink, X, Tesla, cars, right?
Yep. Plenty of those.
Yeah. So if you just do something that's execution risk, just how good you are at making something an order of magnitude better, you can still have a generational outcome, innovate like hell. But you're not like 5 years in being like, no one wants this, right? We're doing financial services, like business banking, fintech. Everyone needs a business checking account. Grinding can pay off if you are in a vertical that actually exists and matters.
Competition is for losers. Haven't you heard that?
Yeah, I have. I mean, that's also true. But if you're thinking on 6-year timelines, for example, you're not competing with anyone. That's what Amazon says, Bezos says. Take something that exists already and do it differently in a way in which you're not going to be competing with someone in 5-6 years. I think that's a surefire way to dominate that vertical.
When someone has raised money, they're burning cash and want, not that they, let's forget the cap table, let's forget all that stuff. What's the roadmap look like to go from burning cash to generating cash? Were there any non-obvious decisions in there you had to make to get to profitability versus continuing to burn money?
Most founders have no sales experience. Going into it, you might think sales are this thing from 1975, right? I certainly did. So your first sales hire is going to be very, very important to teach you what sales are. And I think you want the archetype of a BDR or an SDR.
Did you hire someone right up front to do sales? Or did you do it?
Just before we launched, and I was terrible at sales. We had hundreds of like inbounds from our announcement, like on the wait list.
Yeah.
And I would email them once, and then I would say, okay, they're not interested. But sales is a game of persistence, is what we learned. So we had a very good first sales hire. So that's the first thing, is to get the right person. The first sales hire determines so much in teaching you. And you want someone who's a grinder. You don't want someone from like big tech or like a giant bank or something. You want someone scrappy at the startup level. The other thing is you want to stay extremely lean, because a startup is about time at the end of the day. It's like, how much time do you have to figure this out, work the problem? So the leaner you are, you can find a more sustainable business model that's repeatable over time.
The temptation, though, is that more is better. More people, more money, especially when you started to feel that initial pull of product market fit.
Yeah.
How did you resist that?
I'll tell you this. Every single year in the company's history, investors said, you have product market fit. Now is the time to push the chips on the table. They were wrong every single time. It was never product market fit. You know, the entire business started from zero, like 3 weeks afterwards.
Yeah.
So you just have to be like very skeptical of every part of your business and plan for the worst in everything, in my opinion. Like more is not better, less is better.
How do you balance that with the tension of wanting to build a generational market-leading company?
Well, I think I am, and I think it's because if...
That's what I'm saying, like,
Yeah.
it's a pretty unique... I've found, when we talk about indie, so many people immediately default to like, oh, that's cool. You want to build like little lifestyle businesses and like, you know, that's cool. Like, maybe you should invest in the coffee shop on my block.
Yeah.
They immediately associate fundraising with ambition. And so here you are, profitable,
Yep.
growing fast,
Yep.
with big ambition, and at the same time, you're not even spending the money you've raised.
Let's think about all the companies that have failed publicly, like the giant ones. In almost every single one of those cases, I think they shot themselves in the foot. Bench recently, right? What happened there? They installed a new CEO, they had too much headcount, they grew too fast, right? What if they just grew at a sustainable pace? How would that be going for them, right? If they were doubling, tripling every year. FTX, I mean, that's crazy, that was fraud, right?
Sure.
But just think about every major company that has failed or gone out of business. I think Fast was another one, right? Like,
Yeah.
what would have happened if they stayed in the game? They'd still be around. They'd have generational returns potentially for their VCs. So that's how I think about things. It's, if you stay in the game, you will win the game. So just, that is like priority 1, 2, and 3 is to pick an obvious freaking bet without any market risk and stay in the game. And in a decade, how could you lose? How could you possibly lose? If you just stay in the game, do the obvious thing and make it an order of magnitude better than the incumbents by existing and just keep on pushing the ball forward, how can you not make a generational outcome? That's how I do the trade-off. Like, why would I introduce this risk to the company that could just end the party today?
But aren't entrepreneurs supposed to be taking wild risks?
I don't think so. Do you think so?
No, but I think that's how what a lot of people frame entrepreneurship as is, you know, wildcatters out there taking massive swings and risks, pushing all their chips in all the time.
Who's encouraging that? It's the VCs who want to mark up, right? Or to deploy $100 million so they can get their next fund from their multi-stage VC. It's like, take the wildest, most ambitious, like, risk.
Or I think to your point, bet on crazy markets that don't exist, that actually probably will never exist.
Exactly. So you can PSYOP the LPs into like, look at this, and the LPs get excited because they see the press waves about like AI and like all this. Like, if the LPs are excited, the VCs are happy, right? And they get their new fund. You need to take risk to get reward is just a loser's way of approaching building a generational company. You can have reward with very little risk. And that's just by compounding and not invading Russia in the winter and staying in the game.
I love this because it threads the needle between value investing, right, which is all about compounding, in contrast to what effectively is the idea of power law. Even if only 1 in 10, 1 in 20 succeeds, that one is going to make up for all the losses of the others, right? Which is a totally different frame. And as an entrepreneur, we've conditioned them to believe that they are the outlier.
Yeah.
They are the power law winner, despite the fact that all the odds are stacked against them, versus like you can be the quiet compounder.
I guess like what's the alternative? Like the alternative is like all 10 of them pick obvious bets that pay off in 6 years and they compound like triple every year, right?
Yeah.
The math really works there too. It works even better.
No, it's, I mean, I wrote this post. There used to be a website called Bootstrap Profitable and Proud that 37 Signals, which is like Basecamp, Jason Fried, that whole crew, used to publish. You know, I used to hold it up as an example of like, I mean, the company's on there probably like 10 years ago.
Yep.
And the companies were like GitHub, Atlassian, MailChimp, like 3 or 4 other like now public companies or like massive exited companies.
Yeah.
I would hold that up as an example and said, okay, like snapshot, this is your venture portfolio. You happy with this?
Yeah.
Like this is a legendary portfolio of companies.
Exactly right.
Versus, you know, most firms are lucky to get 1, maybe 2 of those per fund.
Yep.
If that.
It's not going to end well. I don't think any of these places, they're going to all end up zombies. Because you're encouraged to hire. Like if you have even 1 bad hire, that is a cancer cell in my opinion. That person will then hire people.
But when does that tip? Like, do you really think Stripe could go to 0?
I think when you have 1,000 people, your value will slowly erode without calling out Stripe. Look, I'll tell you, I have a radical view on financial services, right? Like, our thesis is this is a commodity. Like, I think we're the first, like, leaning into that. So I think all these services, we want to find the most radical place of, like, the bare bones, like skin of our teeth margins we can take to pass it back. And I think that's the only vector in which anyone will compete in 5-6 years. So if you have an existing company that's based on high margins of financial services, how are you going to compete in 5-6 years?
Yeah.
We're all building the same company, it's no secret, right? So if that's the case, there's only one vector on which everyone will compete, and that's price in 5-6 years. So yes, I think no company is safe that is reliant on high margins to justify a headcount of 1,000 people and 10 plus billion. That's pretty clear to me, in my opinion, and like the savagery is also gone from a lot of these places too. If you're 1,000 people, you have work-life balancers everywhere, right? You have to be extremely low to the ground for a long, long time to avoid disruption, in my opinion. Companies with thousands of engineers, say this AI-assisted coding makes people on average 25% more productive today. I'm not saying it makes you 200% more productive, but that is another tailwind for how if you have an engineering team of 8 to 10, and you just kind of get 30% more productive, you don't take on the scar tissue of having been 1,000 people. You can't go from 1,000 down to 10 and then pass back the savings because of that. But you can stay lean and then use the kind of tailwinds of tech getting better, et cetera, to not have to get to that headcount place as well. So you have a lot of tailwinds that are assisting you in this model. I think it's inevitable. The future is lean. The future is this way.
What's your take on the current state of startups? Like startup culture?
I think especially in Silicon Valley, there's a tendency to try to impress certain people and build companies around what they would find valuable. And that can get you into all sorts of trouble. There's a lot of posturing and things like that. So there's a lot wrong with that because you find everyone building in a vertical that they don't know that well or something they're not passionate about. I think more founders just need to learn to get punched in the face and learn to have that happen day in and day out for years and plan to get punched in the face for 5-6 years. And that's how you build real companies. I think what will help is the funding market drying up a little bit.
I was going to say, pull us forward 5 years. What does that do? Most people look at that and see it as an extinction level event that wipes out a bunch of startups. That's a net negative for the ecosystem. You seem to take the flip side of that.
The ecosystem being like the VC industrial complex. I agree with you. Yeah, but the talent will consolidate. The people, the ability to build.
So you think fewer startups?
Yes.
Fewer startups, more concentrated, talent dense, because the people who might have gone off to start new companies, there's no funding for them, so they'll stay there and grind it out.
Yeah, I think more bootstrapped things, which is great, right? Like people with SaaS moats, right? I love that. SaaS moats with 2,000 people. What is it? DocuSign with like 40,000 people.
Unbelievable, yeah. I mean, I love the memes of like entire full stadiums for their
Exactly. I think SaaS moats go away from savage bootstrap founders, right? That's good for everyone.
Yeah.
Then the ones that are actually like you need to raise money for. I think fintech's an example of something you need to raise money for and have a big balance sheet. The talent density increases. You're all under one roof.
Yeah.
Who's to say? It might not be me. It could be someone more savage than me. When I meet them,
more savage.
When I meet them, I'll let you know. No, I'm just joking. It could very well be someone else, just to be clear. But the thought is savagery will come under one roof, and that will make the venture-backed companies have a higher probability of success than ever before.
I always bristle a little bit when we talk about venture-backed or venture scale. Like it ascribes so much credibility to the venture part. Do you think that changes at all? Like, do you think how people fundraise or think about fundraising changes?
If you and I do our job of communicating this on X, like with the reality of the scar tissue you take on when you raise money, the subset of founders who want to be founders, who want to build a generational company, it will resonate. I'm noticing that already. People are already thinking this way. The ones who want to appear to be founders, it will not affect them. They will continue to try to get the sexiest logos possible, do the cool things on Instagram, et cetera. But more and more real founders will hear this, and that will change the funding landscape so much. I think the idea of raising from angels in your pre-seed and only pre-seed funds, for example, making sure their rights are limited, that will go up. And that's a great thing for founders.
What do you think the hallmark is for these new real founders?
It's just difficult to know what's in someone's bones. Like VCs can say the right things, founders can say the right things, right?
Well, that's why, yeah, like when you and Bryce had that kind of defining conversation in the business post Series A, where he says, you said he was like in his bones, he knows it's the right decision.
It was pre-Series A.
Yeah, pre-Series A.
And we agreed, just to be clear. Look, I can speak to us. Like, I was rejected from 30 colleges. We both went to like Vanderbilt University. That's not the startup like haven, right? I'm from Northern Virginia. He's from like Peoria, Illinois. In our bones is building a real business. I think that's a big factor for it. I don't want to say that's the only factor, right? You can be from Silicon Valley, San Francisco, and build and have it in your bones. That was something that was important to us. It's just not kind of being born and bred in it, and just wanting to build a real business of value. That's something that we understand. If there's someone who didn't come from like the sexiest school or something like that, and they got a chip on their shoulder, I think they're going to build a real business.
Now I'm just being purely selfish. Like from an indie marketing perspective, what's the story we should be putting out there to attract more founders that think like this or that want to build like this?
I think it's got to come from like warm intros from founders who trust you. It's just difficult to because if you're a founder going into your first ever fundraise, you probably think that these VCs know everything and like sexier is better. It's tough to learn that until a founder you admire tells you this is the reality and these are the people you want to talk to. I mean, this is great. I love your content.
Oh, appreciate it.
And again, we'll do our jobs. You and I will change the game.
Look, I mean, if we do our job, then we ought to be able to create this category and own it, that we can kind of shine a light on, not necessarily a better way to build it, but a different way to build it. I think there's a lot more founders that have a hard time admitting that what they're seeing is actually not what they believe. Like if you hold a contrary view to the venture or startup industrial complex, you start to think you're the broken one. You think there's something wrong with you. And I think part of why I love your story and why you're being so vocal about it is I think it gives founders a face, a story that they can attach to that speaks to them in a totally different way than so many of the like heroes' journeys that a lot of people are out there sharing. Or a lot of like the survivorship bias that ends up showing up when sure, you won, but like, was it luck? Was it timing? It certainly wasn't balance sheet, probably.
Yeah, I don't think the business equations work, period, for these giant $10+ billion companies spending a ton growing. They certainly don't work if there's churn, right? So I'm also going to do my part to take everyone to the deepest ocean possible, and we will be around forever, right? Profitable, gigantic balance sheet, zero pressure to do anything that's anti-customer, in my opinion. So what happens like over time is we keep pushing the limits of the deep ocean. There's going to be a day of reckoning, I think, for a giant vertical, which is financial services in the VC world. That's my part, and that'll change the game.
I love it. I love it. Okay, we've gone 2 hours.
Just getting started.
Thanks for listening in to this conversation we had between Brandon and I hope it gives you some new ways to think about what it is you're building. Convention would suggest you have to do it a certain way, and I hope what you heard from this conversation with Brandon is that there's no one way, and the truer you can be to yourself, your own instincts, the more likely you are to find success on your own terms. Like and subscribe, and share us with as many people as possible.